If you are active in the startup scene, you will most likely come in contact with venture capital at some point. But do you know what VC is and how it actually works? In this video, I will give you all the knowledge about what VC actually is. Let us start with a short introduction. Venture capital, or short VC, is a form of private equity and a type of financing that investors provide to startup companies. In general, VC investments only go to companies that are believed to have a long-term growth potential. And so if we're trying to bring it down to a very simple sentence, VC is about buying shares of companies if they are still small and not worth so much, and selling them at a way higher price later on. Let's take a look at how all of this is structured. For most VC funds, there are three main stakeholders involved. First of all, the general partners, or short GPs. These are the managers of the fund. Most of the time they have been investors at other funds before, worked in investment banking, or have founded companies themselves. They are the ones running the show and making the investment decisions. On the other hand, we have the LPs, the limited partners. They give the GPs their money to work with it. LPs are often pension funds, institutionals, or high net worth individuals. Because the risk of investing in startup companies is much higher than the risks of investing in public companies, VC funds need to outperform the public stock markets. So by a significant amount of, let's say, an annual rate of 10% at least, but better like 15, 20 or even more percent. LPs are looking for these kind of returns because the holding periods are long and the money is very illiquid. Most VC funds run 10+ years, and during that time, LPs don't have the option to liquidate their investment. Now that the GPs have enough money to start the fund, we can take a look at what they do with it. The GPs take the money and invest it into different startups with the idea to sell them at a later point with a way higher valuation. So in return for managing the LPs' money, the GPs get a management fee and a carry. The management fee is a yearly fee on the capital that the LPs committed, in most cases around 2%. So as a little example, two GPs raise a fund together with a size of 100 million. They get 2 million per year in management fees to cover their overhead expenses like salaries, office space and more. Besides the management fee, the GPs also participate in the potential returns of the funds, the so-called carry. So let's imagine the lifetime of the fund has ended and all of the portfolio companies have been liquidated. The total proceeds are 420 million. If we subtract the management fees of 10 years fold 2 million, so 20 million, and the invested money of 100 million, the returns would be 300 million. The GPs now get 20% of that amount as a success bonus, or the so-called carry, so 60 million. As you can see, the biggest upside for VC fund managers is the carry in the end. But that also helps to create alignment, because if the fund performs well, LPs and GPs are happy. But how does the portfolio logic behind all of this work? As I told you earlier, a VC fund invests into a group of different startups, their so-called portfolio. Out of these startups, there will be a lot that won't make it because they are running out of money or won't find a product market fit. So the VC fund won't get a return. Some of them will become sustainable businesses that make some money but are not a huge success. These companies might return something in the range of 1 to 3x. And then there are the breakthrough companies, the ones that really found something special and can change the world. These are the ones investors look for. The unicorns, or today's decacorns. Because with these companies, investors can get a 100x or even 1000x on their investment. And as you can imagine, these are also the companies that are responsible for most of the financial returns of a VC fund. So if you think about it, what does that mean for the fund? It means if a business does not have the chance to become at least $1 billion or more company, it won't be interesting for most VC funds because it does not make sense for them to invest in it, because the returns can't be high enough. I hope you liked this little overview about the venture capital world, and let me know in the comments what I should cover next.